Every time a stock trade clears, two people have made completely opposing bets. One person believes the price is going up, and someone else is certain it will fall. One of them is mathematically guaranteed to be wrong. To figure out who is right, investors usually divide themselves into two warring camps. On one side, you have the fundamental analyst, buried deep in financial statements. On the other, the technical analyst, who stares almost exclusively at price charts. Relying on a single method creates a dangerous blind spot. Say you follow the fundamentals exclusively. You find a company with a pristine balance sheet and buy the stock, entirely unaware that a sudden, irrational panic is sweeping through the broader market that afternoon. Your perfect stock drops anyway. Now imagine you are a pure technician. You see a stock chart bounce upward, creating a beautiful historical pattern. You buy the momentum. But because you ignored the financial data, you don't realize the underlying company is drowning in debt and filing for bankruptcy tomorrow. The bounce was an illusion. A successful strategy accounts for both realities. You have to understand what a company is inherently worth while simultaneously tracking the behavior of the irrational herd. Let's look closely at the fundamentalists. Their core theory rests on a simple assumption. The market gets prices wrong in the short term, but over a long enough timeline, the share price will always correct itself to match the company's true intrinsic value. Fundamental analysis extracts quantitative data by parsing balance sheets and calculating exact margins. But this hard data is then weighed against subjective qualitative factors, like the management's track record, brand strength, and corporate transparency. The analyst wants to find a discrepancy. They search for an asset currently trading at a discount to its true worth, buy it, and hold it for the long haul. This method reveals underlying value, but it has a specific limitation. It is blind to the timeline. It tells you what a company is worth, but it cannot tell you when the rest of the market will finally agree. The technician operates in a different reality. To them, intrinsic value is irrelevant because the market immediately discounts all known information directly into the current price. Their core assumption is that human psychology repeats itself. Fear and greed cause prices to move in predictable, visual trends driven by herd mentality. This chart shows how technicians track historical movements. In an uptrend, they look for sequences of higher lows. The triangle pattern squeezes price movements until a sharp breakout. Finally, head and shoulders reversal patterns identify when a trend is failing. To confirm these patterns, they layer on momentum indicators. These are mathematical tools designed to measure the rate of price change and the strength of the movement, generating specific signals to buy or sell. Technical analysis tracks psychology and momentum, but it operates blind to the actual financial health of the asset being traded. Sophisticated investment managers treat these methods as two halves of a single strategy. They use both systems to bridge the gap between financial truth and market reality. Fundamental analysis answers the first half of the investment equation, identifying what to buy. Technical analysis solves for the second half, determining exactly when to enter that position. Consider a real-world application. You dive into the financials of a company and identify it as a fantastic, long-term, deep-value buy. But when you look at the technical indicators, the stock shows zero buying momentum today. Volume is dead. In this scenario, a professional doesn't buy. They use the strong fundamentals to put the stock on their target list. Then they wait for technical momentum to confirm the herd is finally moving in their direction before pulling the trigger. In the unforgiving environment of the financial markets, being right at the wrong time is the exact same thing as being wrong.